Good afternoon, and thanks for joining us for our discussion of how you can go about making your 2019 crop insurance decisions. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and joining me today is my colleague, Dr. Michael Langemeier, who's the Associate Director of the Center and also a Professor of Ag Economics here at Purdue. We're going to talk a little bit about the crop insurance decisions a little earlier in the season than we typically do, but we thought this would be a good opportunity for you to think about what you want to do with your crop insurance in advance of that 2-week sign-up period that we have here coming up in March. So with that, I'm going to turn it over to Dr. Langemeier, and we're going to talk through some of those considerations for your 2019 crop insurance decisions.
We've been saying this for a couple of years now, but certainly take a look at enterprise units. They're a good alternative for many Corn Belt farms, primarily because the premium is quite a bit lower for enterprise unit compared to basic and optional units. And so take a look at enterprise units, compare them to basic and optional units. Also, use products that include the harvest price option. That would include revenue protection and area revenue protection. And we're going to focus today on those two products, revenue protection, area revenue protection. And we'll explain why those are pretty good products during this presentation. 2019 is certainly not a good year to reduce coverage levels. In fact, if you look at revenue protection, for example, even with a fairly high coverage level, you're still only covering about 75 to 80% of cost, even at relatively high coverage levels. And so as you reduce those coverage levels, obviously the percent of cost you're covering is lower than that. And then also, we encourage you again to compare revenue protection and area revenue protection in your county. Area revenue protection is attractive in some locations, particularly if there's more yield variability in your county. Area revenue protection tends to be a product you should take a close look at.
Yeah, and it's a product that's not widely used, so it is worth taking a look at because you probably haven't taken a look at it in the past, right?
Yes.
Okay. All right, let's go through some
definitions. Let's go through some basic definitions. We won't dwell on these too much, but many people are probably already familiar with these. Let's jump to the enterprise units first. This is addition of all basic units in one county for a single crop, and so it's aggregating units for corn, for example, in a particular county. Because it's aggregating, it is going to have lower premiums, and so that does make sense. If you look at basic units, here we're combining a typical specific share of production. So if you all owned in cash rent, for example, is a basic unit. Each share rent landowner arrangement would be a separate basic unit. Of course, share rent is not as common as it once was, and so you probably don't have as many basic units as you did at one time when you had more share rent landowner arrangements. Optional units is a division of basic units based on township section, and so certainly you get coverage that's more specific to a tract of land, but of course you have to spend more money to do that, and so many times the optional units if you choose optional units, it's much more expensive than basic units and enterprise units, and we'll illustrate that in a couple counties in Indiana.
I think one thing to think about, Michael, we've been talking about the enterprise units for several years now, and if you haven't been looking at that, you really should. The probability of an individual collecting on an enterprise unit-based policy is lower, but the cost more than offsets that. The reduction in cost more than offsets that.
Yeah, it really depends on how you think about risk. If you're really trying to protect against those really bad years like 2012, enterprise units is a really good product for that. If you're really concerned that different tracts have different yield variability and you have a lot of variability in your different tracts, then you probably are going to have to compare enterprise units to optional units and make that tough choice. But one of the nice things about enterprise units, if you choose enterprise units, because the premium is lower, you can increase your coverage.
And we think that's pretty advantageous for most people. So if you haven't been looking at that, you should.
We'll talk real briefly about the difference between yield policies and revenue policies. Here I'll focus on yield protection. This insures against production loss for a specific farm. We take our APH approved yield times our coverage level times our projected price. We'll talk about projected price for the last 2 or 3 years in a upcoming slide. You have a choice between 50 to 85% coverage levels. Certainly in the Corn Belt, if you're looking at yield protection, you're going to move towards those higher coverage levels when you're looking at yield protection. These are two very common products, particularly revenue protection. So let's start with that, and then we'll talk about the difference between revenue protection and area revenue protection. Revenue protection insures against revenue loss due to an increase or decrease in price, low yield, or a combination of these two. And so you have a revenue protection guarantee. This is what I was talking about. For a lot of counties in Indiana, for example, you can get a guarantee that maybe 75 to 80% of your full costs or your total cost of production. But this is APH approved yield times coverage level times greater of projected price or harvest price. That very last point is extremely important. Greater of projected price or harvest price. We're going to show you a slide here, particularly during drought years, but when yields are relatively low, sometimes that harvest price is considerably above the projected price. That increases your guarantee. That makes the revenue protection product so much more beneficial in most cases than the revenue protection product with the harvest price exclusion. So we really encourage you to look at revenue protection and not buy the harvest price exclusion product. You have a choice between 50 to 85% coverage levels. In Indiana, typically in the northern half of the state, people are more towards that 85% coverage level. In the southern half of the state, because there's more risk, our yield variability down there, the premiums are relatively high for the 85% coverage level, and so people are closer to the 75 to 80% coverage level. But the revenue protection product is very common. As Jim indicated, we encourage you to take a look at the area revenue protection, compare the guarantee, compare the premiums for that product compared to revenue protection. The disadvantage of the area revenue protection, it assures against countywide revenue loss, and so it's not specific to your farm. Also, the policy protection of the revenue guarantee is based on county yields and not your individual yields, and so that's quite a bit different. But as we indicated, in some cases, this product is fairly reasonable and provides a pretty good revenue guarantee for the coverage level. With the area revenue protection, you go to 70 to 90% coverage levels. Typically, if you choose the area revenue protection, you go towards that higher coverage level.
Yeah, I'd be a little stronger than that, Michael. I'd say if you're gonna think about the area revenue product, you really need to look at the 90% level, and actually there's an adjustment factor where you can bump it just a little more than that, the 120%.
Yes.
That's what you need to compare against, for example, the revenue protection policy.
When I look at revenue protection, yield protection, I always go to the 90% coverage level, that 120% protection level.
Yeah, that should be the comparison you want to make. The other ones, the probability of collecting starts dropping pretty sharply.
And because you got to remember, this is county yield rather than farm yield, and they are different.
Right.
So let's look at projected prices and harvest prices. Certainly in 2019, based on the data we have so far, the soybean projected price is down 50 cents from last year and 50 cents from 2017, but it is higher than 2016. That's worth pointing out. On the other hand, corn has a higher projected price than it has the last 3 years, and so as of this morning, the projected price for corn was right around $4, and the projected price for soybeans is right around $9.55. Now remember, these prices are based on settlement prices of future contracts for the entire month of February, and so these will change. Obviously, as we collect more futures data. I want to talk a little bit about the harvest price, and you can notice there, particularly with corn, that the harvest price was quite a bit lower, but there is some years where the harvest price is higher, particularly if you have relatively low yields like 2012, and that really increases your revenue guarantee, and so that's pretty important to keep in mind.
So I'm going to reiterate something that you already said, but maybe it's to make sure people are really understand what's going on. To come up with the prices that we use today for both the corn and soybeans, we simply took futures prices for the month of February through this morning, through the 19th of February. So we didn't attempt to forecast for the rest of the month. We just took the average so far. And you made the point that those prices are going to change. They will change. We don't anticipate a big change, but you don't know. And so when you look at your actual policy, after the end of February here, make sure you check those prices, and the revenue, the coverage levels are going to change because of that.
That's going to impact the premiums. That's going to impact the revenue guarantees. Another thing, Jim, we probably want to point out at this time is we did use 105% of county yields, and we used trend-adjusted yields. And so we did make those adjustments when we were calculating the revenue guarantees and the premiums.
All right. So let's take a longer-term look at this relationship between harvest prices and the projected prices. So I'll let you walk through this, Michael.
We'll start with corn here. And you'll notice there, if you're looking at 80% or 85% coverage level, for example, there's not that many years where the harvest price is dropping 15 to 20%. There is a few years there, and that's the difference between revenue protection and yield protection. Is revenue protection does protect you against a drop in prices from the spring to the fall. Soybeans, a little different relationship than corn, as you would expect. And again, there's not too many years where the price decline is 20% or 25% from spring to fall. I've got two different lines here. I want to start with this line here, the dash line, or the larger dash line there, and that's indicating an 80% coverage level. And so if you look at the bars below that, there isn't too many times where the price declines 20% from February to November when you're looking at projected and harvested price. But I want to draw your attention to the bars over 1. What this is indicating is times where the harvest price was higher than the projected price, and this is why I say that selecting the revenue protection rather than the revenue protection with harvest price exclusion is the product you want to lean towards, because there is several years in here for corn and soybeans where your revenue guarantee was substantially higher if you had to choose between the projected and the harvest price.
Yes, I think your conclusion there, Michael, is that it doesn't happen often, but when it does happen, it gives you a big bump.
Huge impact. In 2012, some people were very disappointed with the amount of money they received in indemnity costs because they had the harvest price exclusion product. Where if you had the revenue protection product, you got a pretty large check. Let's take a look at premiums. Here we have, we're going to look at two different counties, Knox County and White County, so one in southwest Indiana and one in west central Indiana. And we're going to focus here on some of the higher coverage levels, and I'll focus on revenue protection and area revenue protection, but I do have yield protection in there as a comparison. And you'll notice for Knox County, as you move from, let's look at revenue protection first. As you move from 75 to 80%, that's about a $10 increase in the premium. That extra 5% bump from 80 to 85% costs $20. Obviously you're getting a higher revenue guarantee going from 80% to 85%, but that's rather expensive. And so if you're looking at a higher coverage level, a little bit more protection, think about the area revenue protection product with 120% protection factor, because as you can see, you can get 90% protection for $26.50, which is not that much different than the revenue protection at 80%. And so if you really think you need more than 80% in Knox County and some of the counties in the southern half of Indiana, do that comparison. Look at 75, 80% revenue protection and compare that to the 90% area revenue protection product. Okay. Looking at White County, it's a little different story here. Here the area revenue protection does cost you a little bit more compared to the 85% product, and so you are getting a higher coverage level there, but it does cost you more than when we saw in the southern Indiana case. Let's take a look at the increase in premium here. As you move from 75 to 80%, that's only costing you about $4 to $5. Going from 80% to 85% is costing you about $10. But if you remember the premiums from Knox County, you can get 85% protection level here for not that much money compared to what it costs in some other counties. And so for $20.42, you can get that 85% revenue protection product. Let's look at the revenue guarantees that are based on some of these products. And I want to note here that going from 75% to 80% revenue protection in Knox County, that's going to cost you about $10. And so really what you're looking at there is that additional $35 in revenue guarantee worth the additional $10. In many cases it would be. But I want to point out again that you can get a much higher revenue protection with the area revenue protection product, and the cost is not that much more. It's obviously $40 plus higher revenue guarantee for that product. And you might say, why would people not choose that product? Well, remember, the area revenue protection is county-wide. And so you can't do the optional unit or basic unit with that area revenue protection product. And so the risk is different. The risk you're covering is different. So you do give up something by going to the 90% area revenue protection. But certainly it's a product you should take a look at. Turning to White County, if you go from 80% to 85%, that's costing you $10 again, but you get a $35 increase in revenue guarantee, and for a lot of people that's going to be worth it, that extra $35. There's not much difference in the revenue guarantee for the 85% revenue protection and the 90% area revenue protection product.
You know, one thing to think about, Michael, as you think about area products versus the revenue product, if you've already made the move to the enterprise units, you're already part of the way towards the ARP type of product, depending a little bit on how diversified your operation is within a particular county. If you're concentrated very heavily in one portion of the county, your yields might not mirror what's taking place at the county level, but if you're scattered a little bit more around the county, your yield losses might already mirror those at the county level. So the ARP product in that context might actually look a little more attractive.
Yeah, that's a very good point. Let's look at soybeans. Again, I want to focus on some of the higher coverage levels here. And so if we look at revenue protection for Knox County, going from 75 to 80%, we're looking at about a $6 increase, and you get about an $11 increase going from 80% to 85%. So again, it costs you quite a bit more to go to that higher coverage level. But again, look at the 80% revenue protection premium compared to the 90% area revenue protection. For about the same money, you get a higher coverage level for the area revenue protection product. White County is a little different story again. A lot of people here look at the 85% coverage level for West Central Indiana, and quite frankly, the premiums are not that high, even at the higher coverage level for White County. And the revenue protection at the 85%, very similar price to the 90% coverage level with the area revenue protection. If we look at this chart here, I want to talk a little bit about premium increases again. Going from 75% to 80% for Knox County gives you about a $25 increase in revenue guarantee. That only costs you $6. That seems to be something you should seriously consider, going to the 80% if you've been at the 75% level before. Just like we saw with corn, going from comparing the 80% revenue protection product with the 90% area revenue protection product is something you definitely want to do. There you actually get a decrease in premium with soybeans if you go to the 90% area revenue protection product for Knox County. That's not the case for White County. The premiums are very similar for the 85% revenue protection and the 90% area revenue protection. But again, for White County, going from 80% to 85%, you get about a $25 increase in revenue guarantee for $7. And so that seems to me to be something that you should seriously consider, going to the 85% coverage level. It's no accident that the 80% coverage level for southern Indiana looks like a pretty good deal, and the 85% looks like a pretty good deal for northern Indiana. That's typically what people have been choosing the last couple years. They've been choosing 80% down in southern Indiana and 85% in northern Indiana.
This chart kind of helps illustrate, Michael, the point that you were making earlier, which is that in some counties it makes sense to really look at the ARP product. In other counties it's really not that attractive. And if you look at Knox County, there's a situation where the ARP product looks potentially attractive, depends on your individual situation, whereas in White County, not so much, right?
Yeah.
And that just illustrates why you need to look at the premiums for your individual county and not make a blanket recommendation based on something that's Corn Belt wide. So we'll talk more about that here in just a minute.
One of the things we haven't talked about, because just due to time constraints, is we haven't said too much about the basic and optional Obviously, there's some counties you're going to take a strong look at that too. But one of the things with the basic and optional, in some counties, it really does increase the cost. And so again, if you've been using basic and optional units at a lower coverage level because of the cost, think about going to enterprise unit at a very high coverage level. A lot of times you can go up at least one, if not two notches in coverage levels with enterprise units for the same cost as going to the optional in particular. Other considerations, we're not going to say too much about the multi-county enterprise unit, but this is something that's relatively new, that if you've been using enterprise units and you farm in several counties, talk to your crop insurance agent about that and see what the premiums would be for the multi-county enterprise unit. I did want to talk a little bit about the supplemental coverage option. This is something that was associated with the PLC program. In 2014, most farms across the Corn Belt chose Ark County as the program of choice. We talked about this, I think, in the last webinar, but we've been talking about this in our meetings around the state. PLC is probably going to be a more attractive option, particularly for corn under the 2018 Farm Bill. And so one of the things to think about when you're comparing Ark County to PLC is if you choose PLC, you also have supplemental coverage option as a choice too. And the combination of revenue protection and supplemental coverage option often results in lower premiums because of the subsidies associated with the SCO coverage. And so that's something to certainly consider, not necessarily for this first sign up because it's going to be too late. We're going to already make our crop insurance decision before we sign up. But down the road, when you're thinking about that Ark County PLC, factor in the supplemental coverage option because many times with this supplemental coverage option, you can drop your coverage level and then use SCO to increase your overall coverage level and pay less premium.
And that's a topic that we'll cover in more detail when the Farm Bill details are actually available, because we'll be doing some programming both on the web and in person around the Corn Belt talking about the Farm Bill sign-up, and that'll be one of the considerations. All of our computations are based on the University of Illinois' FarmDoc crop insurance tool. The website address is up there. We encourage you to use either the online version or download the spreadsheet and use it on your own
We've been
computer.
focusing on the premium calculator in this presentation. Another tool to really take a close look at, again, particularly if you're comparing products and coverage levels, is the payment evaluator. That'll, for example, it'll calculate the net cost of insurance, positive or negative. If it's negative, that means there's pretty high subsidies with some of the products you're looking at. But it'll talk about the net cost of insurance for different products, different coverage levels. And there's where I would take a close look at that if you're comparing revenue protection and area revenue protection.
Yeah, that's exactly where you should look at it, because that probability of collecting starts to come in pretty heavy when you make that comparison.
Obviously the calculations are based on history, but nevertheless, history is good information to use when you're trying to choose between products. There's also the Fast Tool spreadsheet. It has many the same features as the online tool, and so if you prefer to use a spreadsheet, I encourage you to download the spreadsheet.
Yep. All right, let's take a look at your updated crop budgets, in particular with respect to kind of high productivity soils, Michael.
Yeah, we just updated this morning, and here we're using, it's very important to point out, we're using 209 bushel corn and 65 bushel soybeans. Obviously, some people have had higher yields in 2018 and 2017 for that matter, but here we're assuming trend yields. These would be pretty high trend yields. If you're looking at APH or trend adjusted crop insurance yields, these would be fairly high. And so this would certainly be high productivity soil if you're looking at trend yields. And the bottom line here is this is full costing. We've got cash costs and opportunity costs included. We've got a break-even price for corn of $4.08. That's been creeping up a little bit. When I started doing these budgets last fall, it was a little lower than that. And fertilizer and fuel have added some costs recently. Looking at rotation soybeans, we're looking at a break-even price of $9.88.
And so, Michael, when you think about those break-evens on a per bushel basis, those are full cost, right?
Yes.
So you've priced in, for example, farmland at full cost rental rate, right? Cash rental rate.
Yeah, let's say you own 1/3 of your land, we actually have an opportunity charge associated with that land that you own. If you own all your machinery, we have an opportunity charge associated with the fact that you could use that money that you have invested in machinery for something else. And so it's definitely full costing. These are not cash break-even prices.
All right, so let's take a look at that. So you look at the break-evens, roughly $4 on corn and roughly almost $10 on soybeans. Let's look at the marketing opportunities that are out there today. So I just did a couple of examples this morning for West Central Indiana. These corn futures earlier today were trading both sides of $4, so I used $4 as a starting spot. I used the Center for Commercial Agriculture's crop basis forecasting tool to help me come up with a forecast for basis in mid-October here in West Central Indiana, and that's an average level for the crop reporting district that covers the West Central district. So recognize that some basis levels could be a little more positive than that, some could be a little more negative, depending on where you're at in that region. So what's the expected sale price for corn hedged today at $4 and delivered in October? We take that DEES-19 corn futures price, add the forecasted or expected October basis, and that gives us our expected sale price, $4 plus the negative 28 cent. Obviously I just flipped a number there, didn't I? Let me think about this for a second. So the 28 cents is the correct number. I had the 13 was actually, we'll come up to that a bit later. So a 28 cent anticipated basis in October gives us the 373. What if you plan to store the corn until late April? And that's where the more positive basis comes in. So we take May 20 corn futures price plus the expected late April basis. That gives us our expected sale price. 413 on corn futures this morning, kind of like on Dees corn. It was trading both sides of that 413 mark. Our expected basis, again using the crop basis tool, negative 13 cents delivered in that late April time frame, and that gives us an expected net sale price of about $4 a bushel on corn, roughly what your full cost break even was on the corn side, Michael. You do the same kind of computations on the soybean side. November soybean futures earlier today were trading both sides of about $9.50. Our West Central Indiana soybean basis forecast for mid-October using the basis tool, about minus 48 cents. If we hedged the beans today and delivered them in mid-October, we'd take that November soybean futures price plus the expected October basis, and that'd give us our expected sale price, so $9.50 plus the negative 48 gives us roughly a $9 net sale price. What if you plan to store those beans until late April? You'd take the May 20 soybean futures price because you'd use that May 2020 soybean futures contract to place the hedge, add the expected late April basis, and you'd come up with your expected sale price. In late April, we'd expect that basis to narrow to about roughly minus 34 cents. Futures for May are higher by 20 cents, so 970. A carry built into that May futures price, add those two, and you wind up with an expected sale price of 936. So the soybean price below your full cost break even, Michael, depending on what you do on your marketing side. On the corn side, we could probably lock in a price that's pretty close coming out of storage to the expected break even on your budgets, which is kind of interesting. So we're not saying you should necessarily place hedges at these levels, but we are saying that you should be monitoring those price levels and thinking about whether or not those are attractive prices for a portion of your crop as you move ahead here through the spring planting season.
And then one of the things that does also pop into your mind is downside risk. I mean, you know, by protecting at least a portion of your crop, at least you protect a portion of it from not having really low soybean prices, because there is quite a bit of downside risk associated with soybeans right now.
That's right. So the trade considerations still loom large especially in the soybean market. All right, let's kind of wrap up with just some of the key points, Michael, on the crop insurance side.
Enterprise units are a good alternative for many Corn Belt farms, and so certainly take a look at those if you haven't used those in the past, including the multi-county enterprise unit products. Use products that include the harvest price option, so revenue protection, area revenue protection. We've focused on those products because we think they're good products, but also people have voted with their feet in terms of that. That's where people have gravitated towards, both of those products. 2019 is not a good year to reduce coverage levels. Many people are at pretty high coverage levels already, so it might not be a year to increase coverage levels, but you certainly wouldn't want to decrease coverage levels to save money. I think that would be a little bit short-sighted. And then compare revenue protection to area revenue protection in your county. The area revenue protection is very attractive in some locations.
And we kind of illustrated one possibility, depending on your individual situation, looking at Knox County versus White County.
And also the corn and soybeans is different too. And so you may choose a area revenue protection for corn and something else for soybeans. And so,
good point. And so I guess our real message here at the end, Michael, is don't automatically do what you've been doing. And that's one reason we were wanting to do this webinar a little bit earlier than we've done it in the past. We typically have waited till the 1st of March to try and do this webinar. But by doing it now, you can actually get in there and spend a little time thinking about this. It is true that the actual prices, the projected prices, are going to change relative to what we showed in the webinar today, but they're barring something unusual happening in the next week or 10 days, they're probably not going to change a lot. And so you can get a pretty good idea of what coverage levels are out there, what it's going to cost you, and make those comparisons and really be ready to make a decision when we get into that 2-week window in early March here, when you actually have to finally make your commitment if you want to make any changes relative to what you did last year.
And one of the things about the tools, particularly the online tool, make sure that you put in the appropriate trend-adjusted yield. It usually starts with more of a county yield, and so make sure you use your yield when you're looking at that. Most people would probably do that, but that's something to point out. And also use the appropriate price. It's going to pop up with just a price. Put in your what you think the futures price is going to be, and that'll change the premiums, change the revenue guarantees for you.
Yeah, if you're looking at it after the 1st of March, I think it will update with the
yes.
actual projected prices
but until
from RMA.
until then, you're going to have to estimate. You're going to have to estimate the price.
Yeah, the tool doesn't do it for you. Good point. So with that, thanks for joining us. If you haven't had a chance to check out the Center for Commercial Ag's crop basis tool, we'd encourage you to do that. That's what I was using to come up with some of those basis forecasts. That's on the front page of our website, so take a few minutes to look at that. And with that, we're looking forward to visiting with you again in the future. Thanks for joining us.